Hello, YouTube friends. There was a recent article on Yahoo entitled Here's What American Teens Spend Money On by Adriana Belmonte. I think this is a fascinating topic. It's so hard to track what the teenagers are spending their money on. The tastes change. It's a bit mysterious. So if you can create an index to do that, it can be interesting. And that's exactly what we're going to do here today. So American teens spent an estimated total of approximately $77.2 billion in 2018, so very big money. Over 8,000 teens were surveyed for this report across 47 states, while the average respondent was 16 years old. So basically, these are teenagers that have some kind of purchasing power, right? So very interesting report. So what we're going to do here is we're going to get data, multiple data sets, and we're going to roll up our sleeves as usual and create this our own index and compare it to the S&P 500. So welcome to the Viral ML Show. My name is Manuel Amunategui. I'm the author of a few books, including this one, a new one entitled The Little Book of Fundamental Indicators, where I share my favorite hands-on market analysis fundamental indicators and data sets. So things we've covered in the past, like the S&P 500, unemployment, real estate, the CPI, the VIX, etc. It should be out by the end of April. Also, sign up upper right corner for my newsletter so you can get advanced access to my material. Connect on Twitter and subscribe to the channel. So this talk will be filed under finance. So on Viral ML site, just click the finance button and you'll see all my other articles on finance that I have so far. So still from the article, Adriana Belmonte's article, a few more interesting quotes. Among upper-income teenage males, most of their spending, 23%, goes towards food. Another 16% is spent on clothing, and 14% is spent on video games. No surprise there. Between both females and males, the total amount of money expected to be spent in 2019 on video games is $235, which is $44 more than the average amount over the last 15 surveys. So this is very interesting, right? So this survey here, this is a survey. It looks like it's every quarter taken on, 15 surveys. We are basically spending the most money in a long time. Kids are spending the most money in a long time on video games. Definitely something to look at, in terms of what's going on in the market space. So. We're going to be downloading a whole bunch of data. Let me make this a little smaller so we can see it. The Jupyter Notebook, the link to the code, of course, is always in the description. All my hands-on videos, the link is always in the description for the code, and there's always a notebook with on instructions and the code. So here we are going to do something a bit different. We're going to create our own index. So instead of just downloading, two products or one product, we're going to have to download a whole bunch of them. So there's a bit of work here. So you can always, first we always get the S&P 500, which is a symbol GSPC. So here you go to the Yahoo Finance page and type, that symbol that you want to download. I'll walk you through one. You click historical data. Click the date range, go max. You want as much data as you can. Go done, go apply, and go download. And it's going to download a comma delimited file to your local machine with all the with the date, the open, high, low, close, adjusted close, and volume for that date range. In this case, for the S&P 500, we go all the way back to 1950. So a lot of good data to play with, and you need to do that for all of them, right? So for example, Starbucks is one where kids are spending their money on. So you take the symbol, right? SBUX, you go to Yahoo Finance, click Starbucks Corporation, and click the date range, go max, and here we go all the way to 1992, done, apply, and download, and that will download. So you'll end up in the end with the S&P 500 and all this basket of stocks. So this is what comes out of the article and the Piper Jaffray survey. These are the hot stocks, let's say, things that are publicly traded. There are things that are not publicly traded. Well, we can't track them, but these are the things that are publicly traded that we're going to put into our index, right? So download all of these and have them in a folder on your local machine, with the same folder where you're having this Jupyter Notebook, so that because the notebook is going to need to access them, pull them into memory. This is exactly what we're doing next. We are going to start off by reading the S&P 500. We're going to put it in memory. Then we're going to cast it to a time frame. Finally, we're going to we're going to drop all the fields except the date and the adjusted close. The adjusted close is better than the close because it includes any changes that happened overnight. And then we're going to rename it because otherwise we'd have all these stocks named adjusted close. So we're going to rename it S&P 500 underscore close, so we know exactly which one we're dealing with. And we're also going to get the percentage change field. The percentage change is going to be the change between one date and the next without ignoring entirely the history of everything that happened before. Just if it went up 1% is 1%. And it's also kind of normalizing the data into this percentage, which is going to be important, right? Because we're going to be creating an index and we kind of want everything to be more or less on the same scale, so that the percentage is going to help us. And we are going to simply print the date range because we want to know when is the first date and last date. Here we're going to do the same thing for the teenage stocks. So there's Amazon, Lululemon, etc. And in here, we're simply going to create an array and kind of loop through all of them, so we don't have to do this individually. And here, I'm not pulling them out. I'm just pulling them out just to get the date range. And this is important because it's going to tell us what kind of dates we're dealing with. So I actually, this is Dunkin' Donuts. I didn't put it in because the data only starts, I think, in 2010. And I really want to get a market crash in there. So I want to get 2007, 2008, because it helps us kind of understand how this index reacts in bad times as well as good times. So I removed it, but you can put it back in, right? This is definitely one that was mentioned in the article. Everything else starts, I think, let's see. The one with the least data is Lululemon, that starts in 2007. That's fine, right? It'll capture part of that, the market crash. So then we need to cut. So this is going to be our date, right? 2007. We're going to cut all the data down to start in 2007. And we're going to loop through it. So we're doing kind of automating it so we don't have to do all these stocks individually. And then we're piling them all one on top of the other. We're discarding the dollar amount. We just want the percentage change. Why? Because it's going to be normalized and they're all kind of going to be on the same scale and we're going to be able to compare them. So here we are creating one monster data frame, and then which is going to have basically two columns, all the dates for all the stocks and all the percentage change, right? So there's going to be, one row for all the Starbucks, one row for all the Lululemon. So there's going to be repeated dates. That's why afterwards, we need to group it. We only want one unique date. So we're going to group it by taking the mean of the percentage change. So that means it's going to take, for a specific date, it's going to take Starbucks, Lululemon, something else, add them together and divide them by that number. So then we'll have the mean value for one date. So in the end, we only have one single date, a unique date for our teenage index and the percentage change. So that's how we created an index using the percentage change. That's really all that we're doing here. And now we get to do the fun part. We're going to plot that percentage change, the raw percentage change, against the raw percentage change of the S&P 500. And it's a rough graph where we can see clearly here the volatility during the market crash, a little volatility pocket here. And we can see the red peaking. So the red is the teenage index. Sometimes it peaks above, or it's more volatile in certain periods than the S&P 500. And that's kind of interesting. So now we're going to do one more chart. This is a bit more interesting. We are going to, actually with two more charts. We are going to plot on the same scale the percentage change with a rolling average of 100 periods. This is going to allow us to kind of make sense of this data. It's going to remove a lot of it, simplify it, and look for a trend. And basically, we're averaging it by 100 periods. We're slowing it down by 100 periods, basically taking 100 period, taking that mean, the next 100, moving it one, another mean of 100 periods. So, and that's going to allow us to see a little bit more patterns. So we're going to do that. We're going to do that for the teenage index, the S&P 500 index, and we're also going to plot on its own scale the S&P, the dollar S&P 500, so we can use that as a guide, as a map, right? So here we see, right? So our percentage change are always going to hover around the zero line, and this is the zero line. In blue, we have the S&P 500. So we see that the market crashed. They kind of both crashed together. This is interesting. But when the market rebounded, like around 2009, look at that. People were eager to start shopping, right? So maybe the teenagers. Keep in mind, some of the companies that we have, it's worthwhile spending a minute on this. We have Starbucks, right? So a lot of, not just teenagers go to Starbucks. McDonald's, not just teenagers do that, right? Dunkin' Donuts, Olive Garden, Chipotle, Nike. So, Victoria's Secret, Lululemon, and Amazon. So they're inclusive of a whole other group of people, right? So you got to take that with a grain of salt. These are not just exclusive stocks of teenagers, because we don't really have it, and that's why we have to create these kind of indexes, right? These are products where, let's say, that $77 billion they spent last year was spent on these stocks. Let's put it that way, right? For the story. So okay, so let's go back to this chart here. So we see when they crashed, they all kind of crashed together. And then there was this eagerness to go spend some money, and we can see our teenage index kind of went up, and it slowed down, and then you just kind of look at, because we don't have that many market crashes, it's a bit hard to look for to kind of create a story out of this. But it is interesting to see that right around 2014, right? Look at that. The teenage index was way below zero, while the S&P 500 wasn't, right? So there was definitely a retail shopping, food shopping drought here, and it got a little bit better. Let's say by 2015, it got better. And here, the first half of 2018, a lot of shopping, right? A lot of the teenage index was above the S&P 500, and then by 2019, they both went under zero for a bit, and now they're both back up, right? So now we've created this index. We're going to look at it. One more way of looking at it, which I like to look at, is taking the same thing, this percentage change, but instead of just looking at them both, like the blue and the red here, we're going to subtract them and only get one. So we're going to take the teenage percentage change smoothed by 100 period minus the S&P 500 percentage change smoothed by 100 period, and still plot on its own scale. So remember, we're calling the axis twin function, so it allows us to have two different or multiple plots on the same chart, but they're going to use different y scales. So now we have our difference, right? This is the teenage index minus the S&P 500 index hovering around this zero line. And then in yellow, we have, just the raw dollar S&P 500 so as a map, right? So we know here is the market, the bottom of the market crash, right? And we are here right now. And then there's a double top. We're kind of doing a double top right now, it looks like. So here we see a little bit better, right? By subtracting them. It removes some of the noise, right? This is still a little bit busy. By taking the difference of these two, the story gets a little clearer, right? So we clearly see that at the end of the market crash, the retail index, right? So I should call it the teenage index, well above the zero line the whole time, meaning it's stronger than the S&P 500. And then the story changes right around 2013. It's kind of an equilibrium, and then it drops 2014. The S&P 500 is stronger than our teenage index. The story changes again 2015 to 2016, and here we have a period, right? 2016, let's say mid 2016 to 2018, where the teenage index is not doing as good. And then again, after 2018, is doing a lot better than the S&P 500. So interesting chart. We created our own index. The point here is that you can create your own index. You don't have to take indexes that are already made. You can take different stocks that you think tell a story. Let's say something about transportation, something about retail, something about research, pharma, biotech, whatever, and create your own index for your own needs. And that's exactly what we did here. Thanks for watching, and catch you next time.